all of us thinking, okay, well, yield curve inversions and lag effects and this, that, and the other. How is that even possible? And the other thing was the NASDAQ pointed that out in September. It was building basically a large bull flag, and it pierced on the bottom end just for like 3-4 days at the end of October. And now it's just absolutely ripped out of that bull flag. So these patterns are there, and they certainly leave the runway that you could make new all-time highs, which is, by the way, not inconsistent with what markets tend to do at the end of a Fed rate hike cycle.
Our next guest is Sven Heinrich. He is the chief strategist at Northman Traders. You may have seen him on CNBC and Market Watch and many other media appearances. Sven is here to talk to us about what is going on with the markets and the current cycles that we're in. Welcome to the show, Sven. Good to see you, finally.
Hi, David. Good to be with you. Thanks for having me.
You were talking to me offline about the cycles. I want to talk about what you mean by exactly that. But first, let me pull up some tweets that you've made in the last couple of weeks. Now, first you said in November, you said when markets are in freak mode and things are close to breaking on some front, Yellen soon comes out and then the VIX gets crushed. So you've highlighted a chart, which I'll show on the screen, different parts of the chart where Yellen is quote unquote concerned. First of all, break this down for us. What do you mean by freak mode?
Well, look, the cycle has been really interesting in the last couple of years. Obviously, we went from massive monetary easing to then a very aggressive tightening cycle as the Fed was basically caught flat-footed. They had overprinted. They were too easy, too long, ignored the inflation machine that was heading our way. And it's not only the Fed, all the central banks did that. And so they got basically steamrolled. This was this whole transitory notion. And then they just had to pile in, and we just experienced the most aggressive rate hike cycle in history. And I think it's fair to say a lot of people, myself included, would have expected something major to break. And last year, obviously, was a fairly intense, I hate to term it a bear market, because in a true bear market, you see actual things break. But it was certainly a drawdown. We saw that in a lot of individual stocks. Tech got particularly hit, and small caps certainly. So there's a lot of damage done underneath. But last summer in 22, I also called it kind of the most controlled bear market ever. And the way I measured this was in form of the VIX. There were a lot of people that rightfully said you don't have a true bottom in a bear market until the VIX hits at least 45, which is completely true historically speaking. We saw that a number of times, 2011, 2015, you name it. Whenever there was a correction of some sort, the VIX spiked in the 40s, and then you had maybe some sort of fear bottom, if you will. That never happened in 2022. In fact, following the Ukraine war, when Russia invaded Ukraine, that was pretty much it. And every subsequent high on the VIX was lower and lower and lower. And it was very odd. It was very odd. And I said a few weeks ago on Twitter, I said, you can either argue with the market, or you can choose to make money in the market. And I've tried arguing with the market myself before, and that just doesn't seem to work very well. I prefer making money. And last year was a prime example of that, because every time you heated that downtrend in the VIX, it was a low in the market. And the comment regarding Yellen is very specifically timed as well, because last October, this was the moment when you were at the edge of actually going into a full bear market. If you look at markets in terms of charts, long-term structures, there was a key moving average I was watching. There was the monthly 50 EMA, and it was also the yearly 5 EMA. These are technical moving averages, long-term charts, and you can look at them back 30, 40 years. They are really important. They're really relevant. And so it was right at that moment when the S&P was hitting those key levels, pivot levels, control levels. And this was also right at the moment when yields were going very high in 22. And we had the gilt issue in the UK. All of a sudden, things were close to actually breaking. And that was the moment. That was the moment when Yellen came out and she said she was concerned about liquidity in the treasury market. And guess what happened? The VIX got monkey hammered. Everything bottomed and flew higher. And it happened again. It happened again in March of this year, when we had suddenly this banking crisis coming out of nowhere, and Yellen got concerned. And guess what? She got concerned, and they introduced the BTFP program, and the VIX got again monkey hammered, and that was the end of that. And then we just saw it again in October. Remember, we had even higher yields this year, partially influenced by the incredible debt issuance by the US government. And every Fed speaker came out and kept pressing the higher for longer mantra, which they had locked themselves into. And all of a sudden, out of the blue, Janet Yellen comes out at the beginning of October and says, higher for longer may not actually be necessarily a given. And guess what? Yields have reversed dramatically since then, right? And lo and behold, we have basically a replay of what we had last year. Yields are reversing, dollar reversing, and
so Yellen is a contra indicator. Is that where is that where we're going with this?
I don't want to be too glib about it, but she's been a beautiful trading signal for bottoms, right? I mean, it's almost like they know things are getting really shaky, and the right things need to be said at the right time. And lo and behold, markets are reactive, more so than to the Fed, which I found interesting. I mean, she's really been a key pivot in all this. And so yeah, I poke fun at the workings of the world when I see it, but these are pretty correlated statements and market action. So I just wanted to highlight that.
Interesting. Going back to the VIX, how do you as a trader use the VIX as a tool? Like you mentioned, lower highs throughout the last 3 years, really. Right now, it's at the lowest point since going back to 2020. I'm looking at this chart. Well, 2021, but yeah, it hasn't been this low since 2020. Is this a forward-looking indicator for confidence, or is this just a coincident indicator for what the market has already been doing right now?
Yeah, I mean, historically, the VIX, obviously, there's a lot of people that will say you cannot chart the VIX; it's a useless tool. Over the years, we've been hopefully proving the contrary to that indeed you can chart the VIX, and that was one of the lead ups in prior to COVID. And of course, no one had a clue COVID was coming. That the VIX was setting up for a big volatility spike. Now you can argue that's coincidental, but it did, and because there was a specific target associated with that as well. But we also have to recognize a market structure and the way markets are evolving, and the 0-day volatility type of option expirations, they probably, I would argue, have also led to volatility compression. So volatility may also be influenced by that. And so we may have lower volatility than we otherwise would. Having said all that, the message is pretty clear, and it was clear last year with these ever lower highs in the VIX, that we were heading towards a lower volatility regime. And there was a really interesting test this summer and fall. And I had pointed this out on Twitter. The VIX had been in a uptrend since the lowest VIX year on record, which was 2017. And so it made over the years a series of higher lows, and this presented a trend line. And so when it actually broke that trend line to the downside this summer, when we had that big rally into July, then the question technically was, okay, what's going to happen if the VIX rises and pings that trend line? And it pinged it in August. It pinged it in September. It rejected each time. And then in October, and then of course, we had the invasion of Hamas in Israel. We got a little bit bigger spike. And the question was always, okay, this is a monthly chart. How is the VIX going to close at the end of the month? And guess what? Each month, the VIX rejected this trend line, and boom, what have we seen in the last 3.5 weeks? Basically a 44% drop in the VIX. Incredible. Now we're at the lows of the year. And one other kind of tidbit on the VIX, where I think it's still incredibly relevant, whether you have OTTE options in the mix or not, is gaps. Ultimately, all VIX gaps fill, and this rally that's been so aggressive has left a lot of open gaps on the VIX above. So my general expectation, we've been bullish, right? And I've got this whole line of analysis that called for this rally here in November, and as bullish as we've been here, now I'm getting a little bit, okay, we still see upside risk, but there's a lot of gaps, and we think the VIX is going to see some more volatility to come.
So let's talk about this rally. So big rally in the larger indices, S&P 500 and NASDAQ, even the Russell 2000 to some extent, although the small caps haven't retraced their July highs yet. The S&P is getting there. First of all, do you expect us to make new highs by the end of the year?
Don't know about the end of the year. It certainly could be. We have to, first of all, recognize that, and this is the way I've been looking at this market over the last several years, is are there any breaks? Are there any breaks of substance? I mentioned early in 22, the monthly 50 EMA held as support, and so did the yearly 5 EMA. In October, we got to a really interesting point of confluence, and technically, I always love confluence when several factors come together. It was the monthly 20 EMA, monthly 40 EMA, and that was the first time they were actually interjecting with price, testing it at the same time. It was just massive support as these markets had become very oversold. And in larger context, what happened is there was a threat that the S&P would, for example, break its uptrend from the 2020 lows. And it did for like a few days, and it rallied back above it. And so all of a sudden you look at this from a big structural perspective, and I'm not talking macro here, I'm just talking purely technically. All of a sudden you're looking at these potential big cup and handle patterns. I pointed that out in September as well, that there was the potential that this could form. And if we break above that downtrend and sustain a move above the downtrend from the January 22 highs to the July highs, you can have a technical case for new highs coming, substantial new highs, which is kind of counterintuitive to all of us thinking, okay, well, yield curve inversions and lag effects and this, that, and the other. How is that even possible? And the other thing was the NASDAQ pointed that out in September. It was building basically a large bull flag, and it pierced on the bottom end just for like 3-4 days at the end of October. And now it's just absolutely ripped out of that bull flag. So these patterns are there, and they certainly leave the runway that you could make new all-time highs, which is, by the way, not inconsistent with what markets tend to do at the end of a Fed rate hike cycle. I've written this article called Market Runway, where you look at historic precedents in terms of when the yield curve inverts. It's not until it actually fully reinverts to positive, and not until the labor market cracks, that you actually see a recession unfolding. For example, when the Fed paused its rate hike cycle in 2006, markets made a new all-time high by September of 2007. That was a runway, right, of a year and a half before all these lag effects actually took place. I can't say when these lag effects really take hold. I would say we're probably already now into a process where the economy is going to slow down. But at the same time, we also have the largest non-recessionary U.S. deficit in history running, which is kind of this fiscal, impetus, if you will, that's running through the system that we haven't seen before. 7-8% debt to GDP is being pushed into the system. So there's other forms of, this may be where the cycle is a bit different. I mean, they're running a deficit that's almost equivalent on a percentage to GDP basis as during the financial crisis in 2009. What happens to market when you have that kind of monetary or fiscal impetus in the system? And that's maybe one of those factors where you say, well, maybe this cycle is playing a little differently, and then there's no end in sight to that, right? At the same time, you have all these debt issuances, which puts pressure on yields. We just saw that this year when obviously they had to raise the debt ceiling and they had to refill the TGA account, which added pressure, supply demand issues with regards to treasuries, right? So there's some complicated, unusual things going on here that may kind of, I would say, distort the cycle a little bit.
So when you're trading the stock markets, first of all, can you give us a sense of your style, your time horizon, and the key indicators you're looking for? Some people are data driven, some people just look at the charts, some people are news driven, some people look at cycles like you do, some people just trade bottom up and they look at just stocks and buy companies that they think are good. Those are more investors than traders. But what is your style? What is your strategy? What do you look for?
First of all, we're not day traders. We're emphasized on swing trades. Now, swing trades, we've been for years been looking at either the short or the long side. It's basically a matter of assessing risk reward. This is where technicals come in, because a combination of signal charts and technical patterns give us a sense, okay, do we want to now be aggressively pushing on the long side or on the short side? And frankly, over the years, this has been I would say, a really interesting educational journey for myself as well, because we always learn in this business, and we learn how markets function and how relevant the signals are. And first of all, technical analysis will not give you 100% of anything. What it will give you is probabilities, where you say, okay, now I don't want to be 100% invested, or I don't want to be 100% long. I want to create flexibility, especially when things get extreme. Same on the downside. You see, okay, there's still downside risk, and there's always downside risk, right? Things can always happen. Things can surprise you. Good example, just now in October, when we had the Israel-Hamas conflict, that came out of the blue. And it impacted markets for a couple of weeks, for sure, because there were concerns about maybe this is going to spread beyond, Israel-Hamas. It could turn into a larger regional conflict. And we saw additional selling as a result. And it challenged us as well. But the signals, all the technical signals that we follow, they were telling us that this market was getting unusually stretched in terms of some of the historical precedences for, call it, oversold signals and so forth. So when you then hit key confluence support, as I mentioned earlier, with the combination of these signals, and then you look at also market positioning, you're in the world of a broader spectrum, and you see CTAs short, asset managers literally having puked out of positions. They were not. I actually put a tweet out on that, said no one's ready for a rally, right? And they weren't. And now they were forced to chase, CTAs forced to cover. I mean, it was just one of those things where everything came together for a perfect storm for such an aggressive rally that even surprised me in terms of the speed of this. So we're looking at a broad range of indicators. They, by the way, which I love about technical analysis, they can keep you unemotional, stoic. It helps you filter out the noise, because there's always the temptation, to get influenced by news, by sentiment, by all the headlines that we constantly get, and by the tape, right? Because when the tape is like really volatile and aggressive, and selling comes in, it impacts psychology. And psychology is one of the most important aspects for any trader in a market environment. You got to be able to detach yourself from that, because if you get emotional in this business, you're going to make errors, you know. And the way we approach this is, first of all, we always use stops. So we always define risk very clearly, and you will get stopped. There's no question about it, but you have the flexibility to react. And then once we have established swing positions, then we patiently, and this is the other operative word, patience, because you don't want to react to every single, you know, you're not on the 5-minute chart. You want to keep an eye on the big picture. You then patiently scale out, which provides you flexibility if you want to re-add on a dip, or, you know, just be aware that at some point things get extreme, but you also want to have a stake in the upside. So it's a process that takes sometimes weeks or even months to unfold.
Okay, you have an excellent chart that you tweeted. This shows the correlation between the S&P 500 shown in the blue line and the liabilities and capital, other factors draining reserve balances with the Federal Reserve. So basically a form of liquidity. You tweeted the perfect liquidity storm, aside from CTS covering shorts, asset managers chasing from low exposure, and buybacks having come back, bank reserves have been cranked up by $246 billion since the beginning of October, and by $130 billion in 3 weeks to the highest level since April. Okay, lots to unpack there. First of all, can you explain just broad strokes why it is that there's such a good correlation between the blue line and the red line, basically liquidity in the banking reserves and the S&P 500?
I could not explain it to you. I just know it's there. Okay.
Right.
And look what happened in March. I don't know if the chart I posted goes back that far. Of course, last year they cranked this up. You know, when I mentioned the October liquidity crunch, you know, there was a lot of concerns, as Janet Yellen mentioned. She's concerned about liquidity in the treasury market. That was basically the time when all this came to an end in terms of, if you view it as terms of monetary tightening, right? This is when markets were really shaky. This is when you got close to a break. And there was, at the end of 22, there was still one slight low, but that was it. And then they cranked up the bank reserves, and boy, did markets rally. So I'm always looking for correlations. You know, we've had tremendous correlations between yields and the S&P. And you can chart these things out with the S&P inverted, the dollar, another one of those. Sometimes these correlations come off, like we saw this summer when tech went into its AI hyperdrive, if you will, and all of a sudden rising yields didn't matter. Markets ignored it until they couldn't any longer. So you got to always keep an eye on, and this is all part of trying to find edges. You know, what's relevant to the market. See, the most dangerous thing that can all happen to us, this is what markets should do, okay? But that's just our opinion. We got to look for what is actually relevant to the market. And this is this whole exercise, which I love about technical analysis. You know, you find the pivots and the spots where you see it's relevant to the market, right? It pivots off of it. You know, call it algos, which are just computerized algorithmic trading programs. They all respect rules, and you got to look for the fingerprints where something is relevant, and that's the exercise there. And bank reserves, fact is, you know, once they really fall down, the market goes with it, and likewise when they crank up, the market tends to rally. You know, and don't forget, there's other liquidity backstops in the market despite all this you know, tightening that we've seen. And the biggest one in that sense was the immediate introduction of PTFP in March, right? When we had the banking crisis, and they provided a liquidity backstop that was supposed to be temporary, but not only is it not temporary, it's ongoing, and it's reaching ever more highs. So there's all these kind of factors that tell you, you know, there's things to pay attention to, right? Unfortunately, like this bank reserves data, we only get it once a week, so you don't have it on a daily basis to tell you what's going on, right? So you can just look at it in hindsight and say, well, that kind of makes sense, and you can chart out the correlation.
Okay, well, Sven, what do you mean by liquidity storm? Is that good or bad storm?
Well, and if you were long in the last 3 weeks, it was a good storm, right?
Right.
I mean, look, you knew buybacks were out during the earnings season, and you knew they would come back. And this is you have obviously seasonality analogs as well, and it's actually interesting, for all the things that I've mentioned, for all the things that have gone on this year. What's the principle? KISS, keep it simple, stupid. It is actually pathetically shocking how correlated the market has been this year with basic S&P seasonality. I mean, it called for a March low. It got that, right? It called for a rally into the summer. It got that. It called for a pullback into September, October, as we usually get. And then a big rally into November, which could extend into December as well, maybe with, a quick dip here in the next week or two, which would actually make sense in context what I mentioned with the VEX, to maybe get some sort of back test out of these big patterns that have broken out. So, on that basis, you can argue, well, this market is just on autopilot, and we are all just, taking all the noise and trying to make sense of it. But, on that basis, it's done what it's always done. In fact, in August, I put out a video called Mega Bull. This was, following the July highs. It talked about a correction coming, but I was looking at presidential pre-election years, which, why would I do that? Well, I came across it by accident, simply because I looked at a whole bunch of years and see how they're acting, and what's been happening. And all of these were kind of the same way, which was that there was some sort of hiccup in the early part of the year, and then they would experience some sort of following summer correction. And then what it specifically said is all these years, be it 2003, be it 2007, be it 1999, be it 2015, you can look at all of these, that there would be some sort of retest of the, August. And the reason I mentioned this is there was a technical, now I never remember what prompted this. NIMO, when we had the correction in August, NIMO is one of those technical indicators that kind of gives you a sense for oversold signals. It got to like 100 minus 120 or something like that. It was extreme. And I looked back in years when that happened, and it was in all these presidential pre-election years. It was kind of, okay, that's kind of odd. And then what it said is, okay, we may make a new low in September, October. It may retest the low, it may make a marginal new low, but the NIMO reading following that big reading in August would make a higher low, which would then be a positive divergence. And guess what? That's exactly what just happened. It just totally repeating it, right? So on that basis, I'm like, wow, maybe we're just, not realizing the program that's there, but that's the program. Now you can argue, well, what happens in the next year is, is this going to be a 2008 like situation or a 2000 situation, which a lot of people expect, and we can discuss that separately, I suppose. But I'm just saying,
yeah, exactly.
I always look for edges, and I look for interesting correlations, and I found that one to be interesting because it basically signaled what was about to come, which was say, okay, we'll have some volatility in the September fall, and then it would get bought. And unfortunately, asset managers and hedge funds, nobody paid attention to this. And that's why they were record short and not positioned. And now they are forced to cover, which creates this liquidity storm, I suppose, in terms of the buying impulse that we just seen.
I do have we're gonna get to your outlook now. That first of all, what you said, the correlation, it makes intuitive sense. So I'm not surprised it's there. You tweeted in early October that the stock market is a bit like society overall. The rich get richer and the rest become poorer. And then you hashtagged a few stocks and indices. What exactly is going to get richer? I'm talking about which area of the markets, which areas of which sectors, and which will become poorer.
Well, I mean, I was making that reference to the fact that obviously what we've seen this year again is the Fab 7 phenomenon, where we, the mega cap tech stocks just seen incredible expansions in market cap weighting. which obviously influences the indices, S&P in particular, while we see large swaths of the market performing horribly. Small caps, banks, equal weight. And actually, that brings me to one of these presidential pre-election years examples that I just mentioned, which was 1999. There's been a lot of legit criticism this year saying, well, the S&P is up, and then now the Nasdaq is up 45% on the year, yet equal weight is basically flat on the year. That's interesting. It's interesting for a couple of reasons. One is that it basically shows that the tightening cycle that we've seen on the side of the Fed is actually producing the results that are consistent with other cycles, which means these stocks are hurting and their earnings are hurting, if you will, right? So in that sense, you can say, well, the cycle is actually unfolding the way it's supposed to. It doesn't feel like it because we have this outperformance in tech. And so that's caused some consternation, and I can look at this in a couple of different ways. One is to just say, okay, well, maybe this is a 99 repeat, because guess what? In 1999, at this time of the year, the Nasdaq was up 65% and equal weight was down like 1 or 2%. But if you use that as a view to be bearish equities, well, you are in a world of hurt, because in those final few weeks, the Nasdaq ended up 100% by the end of the year, and equal weight was still down on the year. So these markets can just behave in very unexpected ways. And if you look at then say, okay, well, then it all blew up in 2000. Well, that's correct, but that wasn't quite as easy as it sounds either, because you had a correction in Q1 of 2000, but then you had all of a sudden a 17% rally in 3 weeks. That actually puts the one we just saw to shame, okay? And then the October lows of 1999, compared that to the October lows we just had now, they were not taken out to the downside until the spring of 2001. Okay, so because there was so much chop going in back and forth. This is why I go back to the earlier 2006 examples. These cycle events can take a lot of time. That's why I'm preaching flexibility and not be stubborn, because these markets can rip in both directions very aggressively and leave everyone confused in the process. Because everybody says it's breaking things down now. Well, everybody that thought things are breaking down now, they're looking at the market now and going, what just happened, right? The other aspect here, and I just looked at this today, which I thought interesting as well, when small caps in particular are I would say, arguably the most sensitive sector in the economy by definition, because they're smaller companies. So, with all that's been happening with higher yields and inflation and tightening, they are most subject to a major breakdown. And I found it really interesting in October here too, because if you look at chart of small caps, they've been chopping in a broad range since the beginning of 2022. Okay, I mean, it's a big channel basically. And I would have thought that when the 10-year, screamed higher here in September and October, that would have led to small caps breaking down out of that channel to the downside. The fact that they didn't, I find interesting. I find it highly interesting, because they should have gotten nailed, but they didn't. And so then you have to look at this in context. Okay, does that mean maybe relative strength? And I go back to my earlier comment about things breaking down. Look what just happened in a lot. I mean, look, we all gone through unprecedented times in our lifetimes. So we had the big COVID crash, right? Because we had obviously an expected, global pandemic, global economic shutdown, da, 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 da. Did the market close down on the year?
That was because the Fed printed unlimited amounts of money. But yes, I see.
That's right. I mean, I go back to that yearly 5 EMA. That's the exponential moving average.
Yeah.
It closed above it. Okay. All right. So yes, unprecedented intervention, but it was basically a 6-week bear move. That was it. And then everything went back up. All right. Now we just went through the most aggressive rate hike cycle ever, following the highest inflation in 40 years, and 2 wars thrown in, and nothing broke. Absolutely nothing broke, because all these support levels are holding. We're above the yearly 5 EMA. Just now in October, we again held support levels, and small caps couldn't break down. What does that tell you? So, I mean, I love a good short myself, but, in terms of pivot of control, and put that in conjunction with an ever lower high in the VIX, something's off, right? And so what I'm saying is, now we're coming out of this. Inflation is coming down. The Fed is pausing. They're done with rate hikes. That is done. And so the traditional cycle would say, okay, well, they're going to hold rates until something breaks, which could be a few months, which could be a couple of years from now. We just don't know.
So bottom line, are you positioned more? Well, would you be positioned more on the long or short end going into Q1 2024, or maybe you're neutral and you're staying on the sidelines?
Well, we've been very aggressively bullish at the end of October. We used the rally to scale out. We still have longs on. But now, because of a short-term move this aggressive, got some seasonal issues there as well, seems prime for at least some sort of pullback. If you look at, and this is where I go back to previous years, very interesting. 99 is one of those examples, but so is 2016, 2004, which had similar moves with late October, early November lows and an aggressive November rally. They pulled back about only 2, 3, 4% at the most, and then they just went higher again. So that's one potential playbook I'm looking at, as volatility again extremely compressed and things are becoming short-term overbought. But these larger structures that I've mentioned that are so structurally bullish, they have room higher. And these technical signals that we're looking at, they also have room higher. While they're short-term overbought, they're structurally not overbought. NASDAQ is a good example. Just incredibly aggressive rally just now. And I'm looking at the NASI, which is a McClellan indicator for the NASDAQ, and it's still in the red. It hasn't even moved to positive yet. One of the things I want to highlight here too, as much as I called it a controlled bear market with certainly a lot of damage underneath in individual stocks, one thing that's really fascinating to me is US high lows, because you see those drop into the red during corrections and then they come back up and so forth. This run over the last nearly 2 years has been the most extensive negative series since the global financial crisis. I mean, the global financial crisis was just a sea of red, right? And that was a really aggressive down move. In this cycle, last year was basically nothing but red. And this year we had a couple of pokes to green. And back in the red here in the fall. And now following this rally, we're still not to green. The reason I mention this is because if you look at all of market history, it is really unusual to have such an extended period of just red readings for US high lows. And so while everybody may be yelling at the Fab 7 for doing so well and masking the damage underneath, you get to a point where you're saying, okay, if you want to be bearish, you have to bet that the most extensive series of negative readings in US new highs, new lows is going to continue negative when there is absolutely no history for it. Okay. As inflation's coming down, as rate cut expectations are coming in, as the labor market has not cracked, as Janet Yellen is introducing a treasury buyback program next year with a motivation to have a soft landing for 2024. I'm also not discounting political motivations. Let's be very clear here. I'm just saying, you know, at the end of the day, we also have to look at probabilities. And if now small caps, with every excuse in the book to have broken down in October with these high yields and not breaking down, what if all of a sudden this whole market actually is following the historic script and we're actually seeing a move to positive in new highs, new lows, and all of a sudden you're looking at a just ferocious melt up possibilities if these structural charts also follow through. So I think that's why it's going to be really interesting what's happening in the next few weeks into Q1. If I get to the point where these structural signal charts get very overbought again, I'll get a lot more cautious again. And also looking at history, Q1 is probably going to be shaky again. Even in presidential years, we see that a lot. So if we come in hot, let's say for argument's sake, you know, we'll have a small dip in the next week or two, and then it just keeps ramping up into year end. We may come in very hot into Q1, makes sense for another corrective move. But then, you know, I have to assess the signals. I'm not in the business of predicting. I'm in the business of probability. And when the signals are screaming to me caution, I'll be cautious. When they're screaming to me buy, I'm on the buy side.
But right now, they're signaling potential pullback, so you're cautious right now, as of today.
Yeah, we've taken some longs off the table. We still have longs on with the view this could still get more extreme, but we want to have the flexibility to re-add on a dip. We have specific levels we're looking at. If these come to fruition, where we're interested in doing that. But right now, after 4 weeks straight up, I give an example. Here's a chart I use a lot. It's the BPSPX, the bullish percentage index on the S&P. That was one of those charts that was a little head scratching in September, October, because its relative strength index was on the floor for the longest period since 2015. Very unusual because markets have a rhythm. You know, it's not always, you know, like for like, but when you get again to one of those charts that say, well, this is really unusual that it's oversold so long, it makes sense for this to rally back up. In fact, I think I posted that on Twitter at some point saying it makes sense for this to go back to overbought, and it just did. It went from like, it was sitting in the 20s for like several weeks on oversold, which is very rare. Usually when it spikes into 20s, it's like a few day event and then it goes back up. This was going on for weeks, and it just ramped from the 20s into 81, 82 in a straight line. That has only happened like 3 times in the last 6 years. So yeah, it can linger, it can move about, it can stretch or what have you, but this is telling me, okay, this is not where I want to start entering new longs. Another example I can give you, the 5 EMA on a daily basis. Also, it's like the shortest term moving average. We use the 5-day exponential moving average. Generally speaking, markets hit that 5 EMA all the time. There may be, you know, a couple of days or 3 days, 4 days at the most when it doesn't hit it. So even if let's say your market moves down, then the 5 EMA is resistance. If it moves up, the 5 EMA is support. It was support on the initial part of this rally, right? Because we had this move up into mid-November, didn't touch it for 5 days. On the 6th day, it touched it and then moved right back up. So it was a clear trading pivot to use. But now, as we entered Thanksgiving, it hasn't touched it in 8 days. Makes no sense. You know, it's again one of those extremes where you say, okay, a reconnect is coming to that at least, right? So those are just type of signals where I'm saying, okay, I'm I'm not interested in new longs right now. I want to see this come back in to key support levels, and then we can talk about re-adding long, for example.
Okay, perfect. Sven, excellent analysis. Thank you very much. Where can we find more of your work and learn from you?
Well, on Twitter, or X as they call it these days, it's at Northman Trader. The website is northmantrader.com. And I have a YouTube channel as well at Northman Trader, where I prose about technical considerations here and there. So that's
Okay,
kind of where I
excellent.
live.
We will put those links in the description down below. Thank you very much, Sven. Appreciate your time.
Thanks, David. Thanks for having me. Enjoyed it.
We'll speak next time when there's a new indicator. Thank you for watching, and don't forget to subscribe and like and follow Sven in the links down below.